Good morning and good evening, depending on where you are in the world. Just to make sure that we can be heard, can someone just post in the chat there that they can hear us, just to make sure we're not speaking into the ether. Meanwhile, while somebody does that, I'll just introduce ourselves very quickly. My name's Kyle with Danny Haythorne, Senior Market Analysts at Capital.com. Of course, this is the weekly Market Mondays webinar that we are doing. It's great to have you along. I'll just double check now that we can get... we've got some feedback there that we can be heard. Nothing yet. Okay, we'll push on and just assume that. Oh yeah, there we go. Can be heard indeed. Thank you very much. Okie dokie. As I was saying, Market Mondays webinar. Great to have you along. Just a very quick compliance update before we get into what we will be speaking about today, and then of course further discussion from there. About what markets are moving. It's just to note that, of course, CFDs are complex instruments and that all the information that you hear in this webinar is of general nature only. It doesn't take into consideration anybody's personal circumstances. People should consider their risk appetite before trading CFDs. And of course, in the UK, spread betting as well. Danny, anything to touch on there just to make sure we're fully compliant?
Good morning, everyone, or good evening, as Kyle said. No, from pretty much what you said, just be aware that these are complex products. For those of you in the UK, as you know, we have spread betting as well as CFDs. Similar thing. They are high risk products. You've got to be aware of the risk involved before trading them.
Perfect. Okay, well, let's go into just some of the general themes at the moment that we'll go through today. Of course, and it happened about an hour after our last webinar, the US-China pause on tariffs stoked risk appetite last week, and really it was off to the races for most of the week after that, at least certainly on Wall Street, which saw the outperformance. We also saw some US data that came in a little on the soft side, inflation data in particular, so it's supporting the case of Fed cuts. There's a bit of UK data, obviously, Danny, which you'll sink your teeth into at some stage, I'm sure, this week, and there's also some figures released last week as well. And in the week ahead too, RBA meets tomorrow. So this side of the world, that'll be interesting, expected to cut rates. And then we'll get some more data as well. PMI surveys in particular could be interesting. And of course, there's a few other stories going on today that are moving markets as well. But perhaps as I just get the platform up, Danny, just so we have a visual aid there in the background. I mean, really the primary driver of the markets at the moment is this sense that maybe trade war risks are diminishing and that we can go and return our focus to hopefully on more positive and constructive things should these pauses turn into perhaps concrete deals and permanent ceasefires, so to speak.
Yeah, indeed. It seems that way. I think specifically the way markets have been moving as well, they really are trying to buy into this less risk scenario for markets. We've seen US equities pushing higher in the last week. There has been some resistance, of course, and that's highlighting that there is some caution within this. We've had comments from Trump over the weekend. Once again, he seems to be heading in the right direction. He was saying that he was willing to go to China to potentially meet with the trade representatives there to kind of resolve this matter. But at the same time, he does send off these aggressive comments every now and then, saying that certain companies, in this example, Walmart, as well as China, should complain less about the tariffs and should not justify hiking prices with the fact that tariffs have caused them, that this is internal issues, that they shouldn't be blaming tariffs for having to raise prices. So again, it seems like everything is heading in the right direction, but in all honesty, and I think markets are aware of this, it's kind of hard to trust the government, the US government right now, in terms of that they won't change from one day to another and that they won't suddenly become conflictive once again. And I think that's where a lot of the caution is coming in. Something else to highlight, Kyle, is the fact that the rally has seen a bit of a pause. It happened towards the end of the US session on Friday. This morning, again, markets are starting to see, as you can see there in the US 500 chart, we are starting to see that bullish appetite turn a little bit in US equity markets. We've seen it in the NASDAQ as well. And I think this comes on the back of that Moody's downgrade of US debt. Now, the downgrade is, I mean, they've downgraded the US sovereign rating from AAA to AA1. So, essentially they've downgraded one step, and I think it's nothing that markets weren't already expecting. But it has caused a little bit of a turmoil. I think it's just revived a little bit of that, that mini sell America trade that we had going on, that move away from US exceptionalism. As I said, I don't think it's a massive surprise for markets. I think essentially they're just catching up to what everyone already thought, that that the size of the US debt is troublesome, and the Trump government is expected to increase spending higher, and therefore worsen the situation. So nothing too unexpected. They're just catching up to what other rating agencies have said in the past. But it has maybe once again reignited that mini sell America trade. Whether this is going to prolong within the week, I think it stands to be seen. As I said, it hasn't been much of a shock to markets. It hasn't really increased in negativity in it. It's just maybe paused that rally a little bit. And interestingly enough, even though they've downgraded because of this build-up of US debt and the likelihood of more issuance, they've actually improved the outlook from negative to stable, the future outlook. And I think that's contingent on a few important points that need to be maintained. And I think Moody's is kind of saying this to make sure, to remind the US government and, the White House that they do have to remain on track with certain goals, and they have to allow certain entities to be independent. So I think the independency of the Federal Reserve is key to these ratings, especially for the future outlook. They have to apply effective monetary policy, and they have to be independent. I think the separation of constitutional powers, again, very important to make sure that decisions aren't politicized, specifically in terms of spending. Again, something that's in question right now. And how the US dollar progresses as the global reserve currency, I think, is going to be key as well. We know we've seen a shift away from US assets, specifically with the US dollar shifting toward more gold-backed currencies in other countries. Now, how the US dollar continues to perform, again, is going to be key for these ratings with US debt. But yeah, I don't know if this is something you've given much thought to, Kyle. As I said, it hasn't been a massive surprise. It's just been Moody's catching up to general sentiment and to what other rating agencies have done so far. But I think it is interesting to see how, once again, it reminds markets that the US debt is in a precarious situation.
Yeah, I have been thinking about it a little bit today. I mean, I think it will be one of those stories that goes away in the next couple of days and will be washed out by something else. I mean, I'm pretty cynical when it comes to the credit rating agencies, more or less rating sovereigns, because technically they can't default. But nevertheless, it is a little bit of a narrative shifter. It does not necessarily provide new information. Of course, we're sort of pretty aware of the US fiscal settings. There's been a lot of talk over the last week, and sometimes that's manifested in a greater degree of positivity in the markets. The Republican spending bill that's looking to be passed, because it's going to add pretty significantly to US deficits, and that in the short term will have an impact on demand. So that was sort of treated more or less that it's a kind of a positive thing, especially in light of the fact that, up until about a week ago, we were all fretting over a fairly significant demand and supply shock in the form of tariffs. But it's added a couple of basis points to 10-year yields. It looks like it's going to take some steam out of US assets. It returns, like you said, us to that story about sell America for the meantime, so the dollar's off as well as stocks and bonds as well. So yeah, it takes some steam out of this rally that, of course, gains a lot of momentum with the US and China talks, but it'll probably subside fairly quickly. I don't think it's that meaningful. We can go into some more of it if we wanted to, but it's probably not even probably not going to even last long enough to really sort of dignify it with too much more discussion time. Danny, obviously you covered it really, really well, but yeah, we're starting the week on the back foot as a result. And you start to talk again about narratives. Where is the next good story going to come from to sort of push this market higher? Because it does seem, at least looking at the charts, that there's a loss of momentum there for US equities. And this might be just a convenient excuse on top of that, just to sell a little bit, because we're 10+% off the lows for the S&P 500. There's got to be some profit taking, some downside, just to kind of clear off some of that steam at some point.
Yeah, indeed. As we were saying, Kyle, you were questioning there where the next big story is going to come. In terms of the calendar this week, it is a little bit busier than last week. We kind of had a little bit of a lull last week, and we saw that in markets just kind of taking the path of least resistance. Is there anything that stands out to you this week? Specifically in the US, I think it's pretty light, the calendar. I think we've got just some regular weekly updates, but other than that, I don't think there's any significant data that could skew sentiment. We do have some data in the UK, as you pointed out earlier, and I think something to notice as well is that we currently have the UK-EU summit going on in parallel to all the US trade talks that are going on. The EU and UK are meeting kind of in an attempt, I don't know if you know this, Kyle, but it kind of feels like they're trying to undo Brexit, which is something that's very hard to undo. But yeah, we've seen these negotiations. They are centered around things like defense, trade, fishing rights. Fishing rights is a big one that's had a lot of discussions between the two powers. And it's kind of, it kind of seems like they're just trying to get closer together, improve their relationship now that I think the tariff situation in the US has put into highlight how important it is to have close relationships with trading partners. Yeah, it kind of feels like the UK and the EU are trying to, strike these deals to make everything smoother, just in case whatever may happen with the US. And we know the US has been very focused right now on the European Union. They kind of stepped aside from China. And I remember Trump saying a comment that the European Union was worse than China or something that they had to watch out for, more importantly. So yeah, the UK and EU are kind of talking in the background, which again, that might provide some sentiment to markets. But also on the UK front, we do have some important data this week, specifically the CPI data for April, and markets are anticipating a rise to, I think, 3.3, 3.4%, depending on where you're looking at. And that's coming up from 2.6% in March. So a significant increase there. A lot of it having to be, or specifically being attributed to things like energy bills, the hiking national insurance contributions that were predicted in the autumn budget, the certain duties on things like vehicles and the increase in, as I said, energy bills. So it'll be interesting to see what the data says. And I think as long as it's these things that were already expected to happen, I think markets will be pretty okay with it. I think something to watch out for will be services CPI. Services CPI has been one of the key sticky aspects of inflation in the last year or so as the disinflation process has started. And that, of course, will have a big impact on the Bank of England and whether it's expected to cut rates further. Current market pricing shows an 87% chance of no change at the next meeting on the 19th of June. But it'll be interesting to see how this CPI data affects this and how, of course, it affects the pound as well, because it has been an interesting story, specifically when you're looking at the cable, the dollar side. The dollar has been very dominant, so cable has seen a little bit of a halt in the recent rally as the dollar was finding some appreciation. But it'll be interesting to see how this CPI data affects the markets and market sentiment. Kyle, I think you've got some Australian events going on, right?
Yeah, we've got the RBA tomorrow, so it's going to be a fairly interesting meeting, I think, because the markets have got a 96% probability that the central bank cuts rates. And it's been like that for basically 2 months now, but certainly the bets ratcheted up around the last inflation print in April for the March quarter. Our official CPI only comes out quarterly. That was a little bit higher than expected, but more or less suggested that inflation continues to trend back to the middle of the RBA's target band, which is about 2 to 3%. The trim mean number, so it's like the core in the United States, is about 2.9%. The reason why it's going to be a little bit interesting is that we had some jobs data last week, monthly employment figures as well as wage data, both which were stronger than expected. The wage data was 3.4% against 3.2% and down from a high of 4+%. So not really indicating that there was any sort of inflationary pressures there. But there was about 89,000 jobs added to the economy last month. And it suggests that basically the labour market is in an okay position, despite the fact that the economy is pretty moribund. So you've got a whole bunch of people down here who are kind of purists and think that you really should only set policy, monetary policy should be set on a backward-looking basis, saying that rates should be on hold still. The employment mandate has been met, so tick, it has been for a really long time. You don't have to protect the labor market yet. And secondly, the inflation mandate has only just been met. Technically, it hasn't yet. It's at 2.9%, and in principle, the RBA is supposed to try and get inflation back to the middle of the target band. However, and this is what the market's leaning into, and I think this is ultimately what the RBA will do, is that, and how they'll sell their cut, is that they'll cut rates more or less preemptively and on the basis that forecasts are still tracking towards the RBA's 2.7% projection for where they think trim mean inflation is going to finish the June quarter, which is the quarter we're in now. We won't get that data for a little while, but nevertheless, we're sort of moving in that direction. And they kind of use that argument that, whole inflation is moving on the right sustainable path in their February decision when they cut interest rates as well. And at the time, inflation was at 3.2% or whatever. So that, combined with some downside risks from global uncertainty and everything like that, means that it's very likely the RBA, in fact, I think it's quite rational, the RBA, or the markets are pricing in that the RBA will cut interest rates almost certainly. But it'll be one of those meetings where there'll be, a bunch of debate about the RBA's reaction function and how they're setting policy. And conceivably, they could surprise, one thing about the RBA since the pandemic is that it's kind of been characterized by a central bank that it's kind of more saying less is more kind of thing, is what I'm trying to say, is that they kind of put their foot in the mouth a few times during the pandemic, especially with forward guidance, and got themselves painted themselves into a little bit of a corner. Over the last 12 months in particular, they haven't given as much guidance and have been pretty comfortable with not doing what the markets expect, and sort of turning around and saying, well, we never told you as much, we never committed to a pre-committed course. But in saying that, it's very, very likely that it cuts rates. The more critical detail will probably be in the guidance as a result, just because the markets are pricing in almost 4 cuts for the year. So another 2.5, call it, after the one that's likely to come tomorrow. And that's where I think there could be some volatility in the equity market and the Aussie dollar, albeit very briefly, because we get washed out by some of these global concerns. Because again, the RBA has been so reticent when it comes to forward guidance that if it doesn't provide much in the way of dovish guidance, then we might see some of those cuts priced out. Aussie lifts slightly, and then equities probably drop a little bit as well. So it could be a fairly interesting one. Probably washed out again by global news by the time Europe opens up and what have you. But certainly, if you're an Australian client, you trade the Aussie dollar, especially the Aussie yen, which has been really volatile recently with some of the risk aversion that's boosted the yen in particular. It could be a volatility event, a big one if they don't cut rates, but still a significant one, even if they do and don't deliver very dovish guidance.
Yeah, I agree. I mean, I think it's justified. We talked about this in the previous, I think, the meeting last week, that central banks are reluctant to give forward guidance. I think the narrative has changed significantly. I think maybe, let's say, 2 years ago, when we were in the midst of the hiking cycle, and central banks were quite eager to give, I wouldn't say forward guidance, but reassure investors and markets that they were aware of what was going on and that they were adjusting monetary policy, and they were, I guess, less reluctant to give forward guidance because they kind of had a bit more of a grasp on what could happen to the economy. They didn't have as the COVID shock kind of died down, they were, I guess, grasping what was going on a little bit clearer. Now, because of the uncertainties, as we've said in the past, with what's going to happen with trade relationships, even though everything seems like it's going in the right direction, they can't be sure that these partnerships and these agreements are going to be agreed on and negotiated correctly in the next month or so. So they are very reluctant to give forward guidance. We've said this about the Fed, the Bank of England as well. Maybe the one that's been a little bit more I guess to some extent reactive has been the ECB, which are again expected to cut rates at the next meeting, which is something will arise when we get closer to the date. But it kind of feels like everyone's just falling in the same line of let's just try and, act on what we're seeing right now, and as we go kind of basis, and try to avoid backing ourselves into a corner. Kyle, I think maybe we can look at a few markets. I know a big one that we always get asked about this, and of course we have quite a lot of interest, is gold. There's a lot of talk of, can we start a recovery? We've seen kind of a little bit of a bottoming out there towards the end of last week. Again, from a fundamental basis, nothing really much has changed. We've said this in the past. Long-term appetite in gold is likely to remain, because there are several fundamental factors that continue to back its price appreciation. All that, of course, includes the central bank buying gold as a potential backing of a new global currency, central banks lowering rates, and that's improving or reducing the cost of holding gold. All of that still remains, nothing has changed. So gold does have a lot of downside support, which is why we see when we see these pullbacks that are justified with short-term news, a lot of it improving global relationships with trade, whether that's geopolitical wars that are going on. Anytime we have an improvement in that, we do see that sell-off in gold based on that short-term news, but it always tends to find that backing based on that long-term fundamental value that remains. So once again, we seem to be at a path here where that sell-off has kind of died down. We've seen a little bit of profit taking maybe from those sellers, finding that support in that current region and potentially looking to move higher. Kyle, what do you think could be things that push gold higher this week, if at all you think that's where it's going?
Yeah, I mean, I'm just sort of looking at the charts here and just noting that, we did get a lot of buying support coming through at like 31.50 and thereabouts, and there seems to be a bit of a rebound afoot potentially, especially now that we're, kind of forming this short-term base. Taking it back to the conversation that we're having last week, I sort of saw signs on the charts of exhaustion, and I was sort of looking at these kind of two highs and failures to break through 3,400 meaningfully. Obviously, the high was at 3,500 as an indicator that maybe things were becoming a little bit stretched in the short term. We know that futures positioning is certainly very heavy on one side of the boat, and the narrative was very, very strong as well, especially around some of these trade uncertainties that gold was the natural beneficiary of that. And since we have seen the US kind of basically backflip on its trade policies and more or less going to damage control, the story for gold in the short term isn't quite as positive. Not just for that too, but because markets are pricing out the odds of rate cuts because of a smaller hit to economic growth because of lower tariffs. But again, if we just sort of look at some of the charts here, it does look interesting that we have managed to hold that 31.50 level. I can't get the drawing tool up right at the moment, but you can kind of see that little sort of short-term downtrend there seems to have broken, and we're looking for maybe a bit of a catalyst to move higher. I still suspect that we've got more downside to go with gold, just on the basis that this trade narrative, I think, is going to continue to improve over the time. Trade deals will eventually get done. I think the US dollar was a little bit oversold, so there'll be some downward pressure on that. But if we sort of break through 3,300 once again, and on top of that, of course, to close above 3,400, that's your kind of cue in the short term that we're seeing bulls continue to control the price. In the bigger picture, and again, my bias is still to the downside here. It's kind of towards that like support around 29.50 that I think will be the really, really sort of strong area of support. That's where I think we might continue to sort of trend to in the short term. Yeah, it's more hunch than anything, just looking at the price action. But Danny, I don't know if you've got anything to add to that there, but I think that it's the same thing. It's that the structural story that you were just talking about is really, really strong. I just think there needs to be a little bit of a deeper pullback before we see really markets push the price higher within that kind of primary uptrend.
Yeah, as I was saying, from a short-term view, nothing really has changed, at least this week, that would justify, unless we say that markets are focusing maybe on that Moody's downgrade story. But as we said, the impact of that is likely to be limited. It wouldn't really, as an investor, it wouldn't really scare you enough to move back again to safe havens like gold and the yen and away from US equities. It just, as I said, it just brings to the front of our minds once again that this sell US story has been quite prominent in the last month or so, and that maybe it was time to take some profit on those US equities. So yeah, there isn't really much that has changed in the short term that would justify a rally from here, other than that support that we've said. As I said, long term appreciation continues, long-term support remains, and that just seems to be the case right now here, just that support coming in. So yeah, it'll be interesting to see if we test to the downside, and if we do, where that stronger support comes in from buyers to say, okay, no, I think now, the sell-off has deepened far enough. This is a good opportunity to buy, considering that gold is likely to remain positive in the long term. So yeah, it'll be interesting to see where that level is. And another one to look out for, of course, is oil. Oil, it has been quite volatile. It's one that tends to mimic the economies and mimic the health of economies quite well. We saw some moves higher last week. That was on the back of some news from OPEC. But again, found some resistance, specifically with WTI, with US crude, I think around that $63 region, pushed lower once again. I think it also coincided with the 50-day simple moving average. So again, providing some resistance there. We know that Trump is a long-term supporter of lower prices. It's something that he's been trying to achieve. And he's actually been touring the Gulf, the Middle East last week, where he seems to strike some important deals in some sectors. And I think a lot of the talk was centered around oil as well. So yeah, it seems like that resistance is held pretty well last week, finding some support as well. I can see there on the daily chart. So again, Kyle, moving higher, lower, what do you think?
I think the trend's to the downside. I suspect that the trend will continue that way. I mean, I think despite global growth not perhaps weakening in such a catastrophic way because of tariffs that probably won't be as high as Liberation Day or when they hit their peak in April, we've still got a deteriorating global backdrop. China's still fairly weak. OPEC has stepped away from managing supply quite as carefully and sort of targeting that notional $65 per barrel level as a floor. There was that range for a while of sort of 65 to sort of $80 that it was trading within. And the other interesting dynamic last week, of course, too, you sort of spoke about, Danny, the charm offensive through the Middle East is rumors of a possible Iran nuclear deal, which I somehow found myself watching Iranian news on Australian free-to-air TV over the weekend, and there was Pezeshkian, the president there. Again, I'm not au fait with Iranian politics, sort of casting a fairly strong and dismissive language of the US's efforts to try and make a deal and more or less corner it by sort of cozying up to its allies, in particular countries like Qatar. But nevertheless, I sort of still think that there is obviously going to be an excess of supply in the market because of OPEC's willingness to increase supply, step away from voluntary cuts, but also probably try and grab market share back partially, and actually probably mostly. This is the Saudis, and in response to that kind of non-compliance to quotas from some other OPEC members. But there's also, the prospect of better relations with Iran, and I don't think there'll be strong enough demand to sort of absorb it. But I mean, again, that's the trend. That's the narrative. It's that $55 mark on the West Texas Intermediate contract that'll be critical, because we did bounce off there a couple of weeks ago, just before we did get that deal coming through from the US and China to pause tariffs. If that breaks, that'd be a very, very bearish signal. On the flip side, looking at that kind of $65 mark there, it would appear to sort of indicate that maybe there's some upside momentum to follow through with. But my bias would be to the downside for oil because of the fundamentals.
Okay, I think we could answer a few questions now, as we're now going on 30 minutes. If you do have any questions, do send them through now. We have a few that have come through already. There's one that maybe I can start off with. I think it's relating to the topic we were talking about earlier about the UK and EU trade, kind of talking about what kind of what companies could benefit from this. I think from the offset, just the improved relationship between these two, which are two important trading partners, will benefit most companies within the regions. I think that the removal of certain frictions, specifically with shipping and logistics, will be very important. So of course, logistic and shipment companies, consumer goods as well, some of the key consumer goods companies, it's very important that these relationships improve. From the offset, things like Unilever, which is a big consumer product in both the UK and the European Union, I think will be important. If we do see these frictions removed, then I think that will be significant. Things like manufacturing, the car sector, automotive sector. So yeah, it's I think realistically most sectors will improve from this. There is a question on to Rolls-Royce and BAE. I believe they are both in the defense sector. Rolls-Royce aerospace, I think BAE is defense. So again, considering that one of the topics of these negotiations is going to be defense, I think in BAE's case, collaboration in the defense sector is going to be very important. So I think, again, pretty significant improvement for them. So we could see some price appreciation for BAE stock. And then for Rolls-Royce, similar thing. If we do see that removal of friction in supply chains between the EU and the UK, I think, again, significant improvement there. I think with the manufacturing sector of aerospace engines and yeah, just commercial aviation as well, I think that can improve. So it does look it does look like we could see some significant improvement and a brighter side for a lot of UK and EU companies if these frictions between both country or both regions improve. And it seems like they're trying to kind of undo a lot of the negative impact from Brexit. So I think, yeah, from the offset, it looks like it will be, it should improve the outlook for a lot of these companies that have strong relationships between both of them. And then Kyle, we've actually we had a question about oil, which we've covered, and the Hang Seng. I don't know if you want to take that closer to your region.
Yeah, sure. I mean, we did have some interesting earnings over the last few weeks in terms of Chinese tech stocks. They're a bit of a sort of mixed bag. I think there was Tencent, maybe Alibaba from memory. We had some Chinese data today, a little bit weaker than expected on the retail side, as well as fixed asset investment. Mostly the Hang Seng has been a trade on US tech and just that tech theme globally. And I think that's, important to emphasize that last week when trade risks diminished, we did see a really strong performance in US tech names because all the money flowed back into those assets in particular, partially as well because they've blown off some of that froth in terms of valuation and their earnings were pretty solid for the quarter. There's an element of that rubbing off on Chinese tech as well because again, if we rewind past all this kind of trade stuff at the start of the year, the big recovery that we saw in Chinese assets was really on the basis that China was catching up on the United States in terms of tech supremacy. The Hang Seng often trades as a bit of a proxy of global financial conditions or US financial conditions in particular. So when we see yields rise and if the dollar rises, sometimes that can kind of choke things for the Hang Seng. The fact that we've kind of lost momentum in equities as well seems to be playing out on the market to start the week, or for Hong Kong to start the week. A very similar setup to what we're seeing on the Nasdaq and the S&P 500 to an extent as well, which is signs of exhaustion in this rally from the lows. A bit of resistance, it would seem, around 23,700. It would appear to me that we're sort of overdue a little bit of a pullback and maybe a view of kind of pulling back into that sort of mid 2200s, 2250 level wouldn't be unreasonable to think throughout the week, especially if we don't sort of recapture a sort of a positive narrative with trade. But just be conscious of the market making new highs with a positive catalyst. 2400 is going to be a really significant level. There'll be a lot of wood to chop through there because obviously that was kind of the highs that we saw when the market was rallying hard on that kind of deep seek stuff before trade really subverted everything. But nevertheless, I mean, it's a story about trade. It's a story about AI globally, but specifically in China. Technically, I think we're due for a little bit of a pullback, but if we continue to see a positive trade and tech narrative, then that's going to be a sort of a buy the dip dynamic. We'll probably continue to see the market move higher.
Great. Well, I think we've covered most of what's going on this week. We've covered, again, a little bit of a lighter calendar, specifically if you're looking at the US. We've covered some key data that we have in other regions. I think we've covered most of the questions we have as well. So Kyle, if you've got nothing else to add, I think we should stop here. Thank you everyone for joining us as always. Please join us again next week. We'll be here at the same time covering anything that has happened this week and of course looking ahead at the week following. Thank you everyone. Kyle, thank you. Good
Thanks,
evening
Jay.
and good day everyone else.
Great week. Bye.